Welcome to Introduction to Finance, Finance 201. This is chapter 1 of your textbook. We follow along right with the textbook as I go through this. It'll be as we try to stay under 10 minutes and it'll be placed on YouTube. One of our first issues is what is finance? Finance is not just credit. Okay, you may think that it's credit or borrowing, but it's more than that. Finance is the study of valuation. So we look at how to value things. Things are only worth as much as they will produce in cash flows in the future. Just think about a business you're going to buy. If it doesn't produce, one business produces more cash flows than the other with the same level of assets in the same machine, then you're going to buy the one that produces more in cash flows from the same investment. Okay, so it's worth more. So we look at the study of valuation. We value stocks and companies and projects all the same way. We just depending on future cash flows. On Wall Street, there's a lot of folks that are paid good money to value investments. We can also call it the art and science of managing money. It deals a lot with money management. People that come to mind, I would highly recommend reading some of these folks. Robert and Kim Kiyosaki, they wrote Rich Dad, Poor Dad and Unfair Advantage and several other books. I'll mention those folks several times. Steve Jobs with Apple, the CEO or former CEO, I'll talk about him a lot. Dave Ramsey in the middle, he wrote a lot of personal finance books, one called Total Money Makeover, Financial Peace, several others for folks to read about. We've got to understand cash flows to understand how finance works. But Weird Al says it's all about the Washingtons, and it is. It's all about cash flow. You have to look him up if you don't know it. The top right-hand corner says people with no money but ideas and time. So some of us are investors, and we want to put our money to work, but we don't want to operate the company ourselves. So we give our money to companies, usually by buying stock, sometimes by loaning money to companies. We invest in projects. The companies invest in projects that they think are going to be successful and produce cash flow, positive cash flow. Okay, so down the bottom, so where it goes from there, if they're successful, like Apple investing in the iPad 2 project, which the iPad's been very successful, where do you go from there? If you have extra cash flow you created, you either pay it in taxes to the government, which we can't get around. We might, at the top arrow called retained earnings, we might reinvest it in the company and then try to put it to work again on the iPad 3 in the case of Apple, or we pay it back to shareholders in the form of dividends or interest. So we reward our shareholders, and that's on the very right side. If you like the idea of the investment part, you might be a financial advisor, financial planner, investment manager, and that's the New York Stock Exchange there on the right, by the way, and that's a very exciting field and one of the most highly compensated. On the left side there, if you like the business finance part, most of you will end up working in that section. You might work with things like a TVA, financial analyst there recently had to help TVA decide whether to invest in a nuclear plant that was partially finished. So should they bring this plant that's 80% done back to life, or should they invest that money in building a new plant or some sort of alternative energy? And the financial analysts there help them make that kind of decision. You might do some financial report or things like that too. Last there, the financial institutions and markets. That's you facilitate transactions, you help people get capital. So you might be a loan officer, a commercial loan officer, working in an investment bank like in America there. The financial function is a little bit different than accounting. Accounting tracks past information. They deal with databases and ledgers and transactions. Finance really looks at predicting the future, trying to predict those future cash flows. And if you're good at it, you get paid really well to be able to do that. The financial manager, how it looks, you have a board elected by the shareholders. They appoint a CEO to run the company every day. The board members aren't there every day, but they elect a CEO to run the company every day, and usually a CFO or CEO is Chief Executive Officer, CFO is Chief Financial Officer that supports the CEO, and the treasurer and controller usually report to the CFO. The treasurer has functions like you see listed in the bullet points there, managing cash, raising additional capital. The controller tends to be the chief accountant, so to help understand the functions. Business and personal finance are very similar. You'll see the similarities there, and we'll continue to see that go throughout the course. Business forms are very important to understand. The big things to remember here, there's 3 forms that we focus on: sole proprietorship, partnership, and corporation. Sole proprietorship and partnership are very common in the U.S. just because they're easy to form, but they have unlimited liability. Someone breaks their foot on your property, like at the ice cream and coffee shop we have downtown, if they were to break their foot on your property, then everything, both the business assets and your personal assets, are exposed if you have those business forms. But the benefit is comes in taxes. You only pay tax once at the owner level in either of those forms. The corporate form, which you're familiar with, the good part of that is you can raise money easily, so easy access to capital because you can issue new shares or sell your shares. Okay, you can transfer shares easily by selling them. And you also have limited liability, okay, because there's actually a separate business entity at that point from the person. So your personal assets aren't at stake when you have a corporate form. Biggest drawback, the reason why everyone doesn't form a corporation, is because you pay income tax twice. Really, on the income that's taxed at the corporate level, and when it gets to the individual level, you pay it in the form like if dividends are paid out, you pay tax there too. You see the sign there, taxes always, death, there's a loophole. That's really funny. I like that, so you can read the details. But that's the biggest thing between those 2 forms. An alternative form called the hybrid form for small to medium-sized companies. I like the limited liability company because you have liability protection of a corporation but one tax layer. The reason why everyone doesn't use these alternative forms is because there's limitations on size that you have with a corporation. Last, closing up, the firm goals. One of our goals is to biggest goal is to maximize shareholder wealth. Shareholder wealth is really maximizing the value of your shares, really the ownership or equity. Equity means ownership. Okay, so we maximize your ownership value. Okay, and the way we do that, we've talked about cash flows. The more cash flows you can produce in the future, or our expectation of future cash flows, the more something's going to be worth today. So we try to maximize that, maximize what future cash flows might be. And that's where, if you're Robert Kiyosaki focuses on cash flows, and if you read any of his books. The agency theory, you'll see that managers are agents that the CEO elects to run or hires to run the company. Okay, that sometimes there's problems though. There's a conflict with what they want personally and what would be best for shareholders. You might get by on the Mini, like Mr. Bean on the left, but you ask for the Lamborghini on the right. So you have a $200,000 difference there just for preference. Okay, how to deal with that kind of tension is we can ignore it because we think that it's still better for the manager to be happy because they'll make us more money. We can micromanage it and try to tell them exactly what limits they have on everything. Or we can tie compensation to ownership, which is what a lot of companies do. As you've seen, we award stock or options to reward our managers. And you can see that the Coke CEO, out of his $18.8 million in compensation, $7.4 million of it, a good portion of it, are in stock options. So if he does well, his individual investment does well, and everyone else does well. Okay, last thing to mention is we have watchdogs we call corporate governance, and that's everyone that looks over the company. And we have, of course, the government we know does that through a Securities and Exchange Commission. You have to file an annual report if you're a publicly traded corporation every year for everyone to be able to see and the SEC to be able to see. We have bankers that are always analyzing financials if you're trying to obtain new money. The board oversees the company. Auditors would also see, like those CPA firms that verify financial statements would look over the